What's good, everybody? Welcome back to Boni's Life. I'm Boni, and this is your crypto weekly analysis for the week of Monday, June 29th to Friday, July 3rd, 2026. We are recording this on Sunday, July 5th, right after the US Independence Day holiday weekend. And listen, this week nearly gave me a heart attack. I'm not even joking. I opened my portfolio on Wednesday morning and thought my phone was broken because the numbers just didn't make sense. Bitcoin crashed to a 21-month low, Ethereum was bleeding, and the fear and greed index was screaming extreme fear at 16. But then, just when things looked their darkest, a shocking US jobs report triggered a massive short squeeze that sent prices surging back up. What a week. Let me break this whole thing down for you properly. Monday, June 29th. The week opened under a thick cloud of pessimism. Bitcoin was trading at approximately $60,128, hovering just below the critical $60,000 psychological support level. The total cryptocurrency market capitalization had contracted to between $2.10 and $2.14 trillion, its lowest point in nearly 2 years. The fear and greed index registered 16, signaling extreme fear, the deepest panic reading of this entire cycle. Ethereum opened at $1,573, with its market dominance slipping to 9.3%. Network activity on Ethereum was virtually non-existent, with gas fees dropping to a mere 0.06 GUI. Think about that. Gas fees so low, it was basically free to use because nobody was using it. That's how dead things were. The Morningstar AI index had just fallen 6.1% over 2 days, dragging broader tech sentiment into negative territory and pushing capital towards safe havens, particularly the US dollar. Monday felt like walking into a funeral. Everyone was scared. The market was dead quiet. Moving into Tuesday, June 30th, the end of the second quarter and the close of the month, Bitcoin opened marginally higher at $60,148, while Ethereum opened at $1,610. But the broader context was deeply sobering. June 2026 officially went down in the history books as the worst month for Bitcoin prices in 4 years. The last time June was this bad was 2022, and we all remember what happened then. The structural damage was evident in the ETF flow data. Bitcoin ETFs recorded $222.6 million in net outflows over the course of June, marking over 2 consecutive weeks of institutional withdrawals. The big money guys, the institutions, the ETF buyers, they were all running for the exits. Without fresh institutional capital entering the market, sustaining any upward momentum was virtually impossible. Furthermore, stablecoin liquidity continued to deteriorate. The total stablecoin sector capitalization fell to approximately $313.2 billion with a 7-day net capital off-ramp of $2.1 billion. That's the blood supply of crypto draining out. Capital was actively fleeing the ecosystem, leaving the market exposed to further downside risk. Then came Wednesday, July 1st, the darkest day of the week. The dam finally broke. Bitcoin plunged to a 21-month low of $57,742 during Asia trading hours, as confirmed by Bloomberg. This sharp decline was driven by a convergence of rate hike fears and growing contagion concerns surrounding major corporate Bitcoin holders. Specifically, STRC, the yielding component of a major corporate Bitcoin strategy, dropped to approximately 75 from par at 100, while SATA fell to around 88. This entity holds roughly 4% of the total Bitcoin supply. Now, 4% on its own is not necessarily systemic, but when fear is already at extreme levels, any sign of weakness in major institutional holders triggers panic selling. It's like if Eskom announced they are bankrupt, everyone would panic, even if the lights are still on. That's what happened. Pure fear. Ethereum followed Bitcoin down to $1,569. The market was staring into the abyss. On Thursday, July 2nd, the market began showing tentative signs of stabilization. Bitcoin recovered toward the $61,000 level, opening around $60,000 and pushing up to $61,030. However, the underlying data remained deeply concerning. Weekly spot ETF net outflows accelerated to approximately $1.58 billion. Global digital asset ETP issuers recorded around $1.4 billion in net outflows. The market was absorbing massive institutional selling pressure. Yet, and this is the critical observation, despite this relentless selling, Bitcoin was finding buyers near the $58,000 level. Think about what that means. $1.58 billion left the ETFs this week. That's massive selling. But the price was going up. Someone was buying all that Bitcoin that the institutions were dumping. Who? The long-term holders, the diamond hands, the people who've been through this before and know that when everyone is panicking, that's when you accumulate. We also received wage data on Thursday showing consumer spending remaining stronger than expected, keeping the Federal Reserve in a hawkish position and supporting the higher for longer interest rate narrative. And then came Friday, July 3rd, the defining moment of the week. The non-farm payrolls report was released early because the following day, Saturday, July 4th, was US Independence Day. The data was an absolute shock. The US economy added only 57,000 jobs in June, catastrophically missing the market expectation of 110,000 to 115,000. 57,000. The market expected more than double that. But it gets worse. May was revised downward from 172,000 to 129,000. April was revised downward from 179,000 to 148,000. They revised everything downward. The unemployment rate dipped to 4.2%, but primarily due to a collapse in labor force participation. This was the lowest job gain in 4 months. The American economy is way weaker than anyone thought. The market's reaction was immediate and violent. The probability of the Federal Reserve raising interest rates in September, which had stood at 66% just before the report, plummeted to 51%. The US dollar index fell 0.55% to 100.85. The 10-year Treasury yield dropped to 4.483%. And that is when the fireworks started, a day early before Independence Day. Because here's the thing. If the economy is weak, the Fed can't keep raising rates. And if rates stop going up, money flows back into risky assets like crypto. A weaker dollar and lower yields are inherently bullish for Bitcoin and all risk assets. This was the exact catalyst the market needed. This macroeconomic shift triggered a massive short squeeze. Traders who had aggressively shorted Bitcoin during the plunge to $57,742 were caught completely off guard as the price rose on the weak NFP data. These short positions were forced to cover, buying back Bitcoin to close their trades and adding explosive fuel to the upward move. According to CoinGlass, short liquidations across the crypto market approached $450 million in a 24-hour period. $450 million in shorts got destroyed. Every time a short gets liquidated, it pushes the price up even more, like a snowball rolling downhill. Bitcoin surged to $61,853. Ethereum bounced strongly, opening at $1,698, up 5.6%, and climbing to $1,731, from $57,742 on Wednesday to $61,853 on Friday. That's over $4,000 in 2 days. The market violently rejected the 21-month lows and reclaimed the critical $61,000 level. Now, while that bounce was impressive, we must maintain perspective. If we zoom out and look at the year-over-year data, the reality of the current bear market becomes clear. Bitcoin is currently down 43.5% from exactly 1 year ago. The all-time high was $126,198 on October 6, 2025. We're at $61,000. That's less than half of the peak. Ethereum is down 33.9% year-over-year from its all-time high of $4,953 on August 24, 2025. Yes, Friday was amazing. But let's be real. We are still deep in a bear market. Don't let one good day make you think the bull is back. One strong jobs report does not instantly reverse a year of macroeconomic tightening and institutional outflows. We've got a long way to go. Stay humble. Stay cautious. That said, there are structural positives emerging that we need to acknowledge. One of the most encouraging signals this week is that whale selling has slowed dramatically. Based on historical 4-year cycle patterns, the intense selling pressure that began around October 2025 was expected to taper off approximately 6 to 9 months later. We are now within that window, and the data confirms the selling is indeed cooling. Think of it like this. Imagine someone's been pouring water out of a swimming pool for months. Now they've stopped. The pool isn't filling up yet, but at least it's stopped draining. While whales historically do not return as major buyers until closer to the next halving cycle, in 2028, the cessation of their selling removes a massive weight from the market. The supply side is becoming less aggressive, making it easier for smaller amounts of demand to move the price upward. On the institutional front, Intercontinental Exchange, the owner of the New York Stock Exchange, and OKX announced a 50-50 joint venture to build infrastructure for tokenized and digitally native products. Subject to regulatory approval, this venture will operate as a US-registered broker-dealer, giving OKX's customer base access to ICE futures and NYSE tokenized equities. The New York Stock Exchange is building crypto infrastructure. Let that sink in. The biggest, most prestigious stock exchange on the planet is saying, we believe in this. While this does not solve immediate liquidity issues, it is structurally incredibly bullish. The plumbing for the next bull market is being built right now, during the depths of the bear market, by some of the largest financial institutions in the world. When the NYSE builds something, you pay attention. On the regulatory front, Binance withdrew its MiCA application with Greece's Hellenic Capital Market Commission just days before the July 1st deadline, requiring crypto firms to hold a license in at least one EU member state. Binance stated it will seek authorization in another EU country and emphasized that it is not leaving Europe. While not a direct price catalyst, this keeps regulatory uncertainty in focus for global exchanges. The compliance landscape is shifting rapidly, and major players are constantly having to adapt their operational strategies across different jurisdictions. Now, here's something that really excited me this week. The director of the Federal Housing Finance Agency, William J. Pulte, ordered Fannie Mae and Freddie Mac to prepare their businesses to count cryptocurrency as an asset for a mortgage. He literally said, I want people who own cryptocurrency to be able to buy homes like everyone else. I believe cryptocurrency is an asset. Do you understand what that means? If Fannie Mae and Freddie Mac, the government-sponsored entities that fund a massive portion of the US mortgage industry, begin accepting crypto as collateral, it fundamentally changes the utility and mainstream acceptance of digital assets. If you hold Bitcoin, you might soon be able to use it to qualify for a home loan. That's real adoption. That's crypto moving from speculation to actually helping people buy houses. It bridges the gap between the digital economy and traditional real estate. This is a monumental policy shift. As we move into July, there is a well-documented historical pattern. Whenever Bitcoin experiences a deeply red June, prices often rebound to deliver a green July. Given that June 2026 was the worst month in 4 years, the market is heavily anticipating a reversion to the mean. Friday's violent bounce certainly lends credence to this theory, and so far it's looking good. However, historical patterns are not guarantees. The macroeconomic environment today, characterized by high interest rates, quantitative tightening, and institutional outflows, is vastly different from previous cycles. Use the pattern as a guide, not a guarantee. Relying solely on the calendar to dictate trading strategy is a dangerous game. We also must factor in the geopolitical landscape, which showed signs of fragile improvement this week. The United States and Iran agreed to halt attacks and renew talks, reducing the immediate risk of a severe oil shock. WTI crude oil retraced to approximately $70 per barrel, near pre-war levels. Lower oil prices reduce inflationary pressure, which lessens the urgency for the Federal Reserve to maintain aggressively high rates. However, the weekend saw tit-for-tat strikes that underscore just how fragile this agreement remains. Geopolitics remains a significant headline risk that could upend the market at any moment. The overarching theme of this market right now is the Federal Reserve's approach under Chair Kevin Warsh. Warsh has made it clear that the Fed will provide less forward guidance and react more directly to incoming economic data. This means every major inflation and employment release is going to trigger heightened volatility. We saw this play out perfectly this week. Weak NFP data instantly caused a massive repricing of rate expectations and triggered a violent short squeeze. In a data-dependent regime, the market is constantly on edge, waiting for the next economic print to dictate direction. There's no more, the Fed told us what they're going to do. Now it's, let's see what the data says and react. That means more volatility, more opportunities, but also more risk. You need to be ready for anything. Looking ahead to the week of July 7th, with the Independence Day holiday behind us, we are entering a full 5-day trading week, and the focus will pivot directly into the second quarter corporate earnings season. In an environment of higher interest rates, companies are going to be judged strictly on actual profits and forward guidance. The era of cheap capital fueling speculative growth is over. If corporate earnings show weakness, it could drag the broader stock market lower, pulling crypto down due to the ongoing correlation between tech equities and digital assets. Furthermore, we are awaiting the next consumer price index inflation data. Given the Fed's data-dependent stance, the CPI print will be the next major catalyst. If inflation comes in hotter than expected, it will erase the dovish sentiment from this week's weak jobs report, and Bitcoin could retest those 21-month lows. Conversely, if inflation shows signs of cooling, it will reinforce the narrative that the Fed may pause or even cut rates, potentially fueling a sustained rally through July. CPI is the big one coming up. It's literally make or break. The market is currently trapped between these two competing macroeconomic forces. So how should we approach this market? The preferred strategy right now is tactical caution. The recovery from $58,000 was constructive and proves that buyer interest still exists at lower levels. The $450 million short squeeze demonstrates that betting aggressively against Bitcoin at these levels carries significant risk. However, the market needs to cleanly reclaim and hold above $61,000 before the risk-reward ratio truly improves for buyers. A sustained hold above $61,000 opens the door for a move toward the $63,000 to $67,000 liquidity zone. But until we see a reversal in ETF outflows and a return of stablecoin liquidity, rallies should be treated with healthy skepticism. In simple terms, don't go all in right now. Be smart. Use stop losses. Don't risk more than you can afford to lose. And please, don't use leverage right now unless you really know what you're doing. All right, let me bring this all together. This was a historic week. Bitcoin survived a terrifying plunge to a 21-month low of $57,742. only to be rescued by a shockingly weak US jobs report that triggered a $450 million short squeeze, pushing the price back up to $61,853. While the immediate panic has subsided, the structural challenges remain. ETF outflows, tight liquidity, and a data-dependent Federal Reserve that keeps the market on edge. As we head into Q2 earnings season and await the next inflation data, volatility is guaranteed. The market is alive, it's volatile, and it's full of opportunities, but also full of traps. Keep your risk tightly managed, set your stop losses, and do not let the emotional swings of the market dictate your strategy. Stay disciplined, stay informed, and most importantly, stay in the game. Thank you for joining me on Boni's Life. I'll see you next week with another deep dive into the crypto markets. Stay safe out there, people. Peace.